So, I'm back with our first homework assignment. Your first homework assignment is to work on your financial health document. Financial health checklist is a document available as a free download on my course. And you may have downloaded it before and worked on it. If not, you have to do it as a part of the home assignment for this course. There is a video with explanations how to work with this document. In short, you have to fill in the checklist with yes and no's first. You have to define your financial priorities. They will be there. You can choose from many of them. And you make a list of your financial actions. So this is your homework assignment. And you need to print the document before, as you have noticed, because it will be difficult to do it digitally. So that's your first homework assignment, and let's progress with the learning. We already discussed that you have to know your earn, spend, and save. You have to know it as a percentage, and you need to reflect on it. What you have to understand that investing is essential for saving. Saving is not possible without investing. And that's why you're here. That's why we're learning about investing, because it's absolutely essential. What happens if we don't invest? Well, we are losing money. We are losing money little by little, or actually today we are not losing money little by little. We are losing it very quickly because of inflation. This is actually a rather old table. It has been done in the times of very low inflations. The times of low inflations which we used to have, which was below 2%. And even with pretty much non-existent inflation of 2%, you can see that your savings in 20 years will go to almost half, and in 30 years, it's left half of your investments. So if you don't invest, you have your savings just sitting in your account. This money is disappearing. Today is disappearing pretty quickly because in the last year, inflation was 10%. So today, your savings are 10% less than what it was last year. And the year ahead, we expect the same rate of inflation. It is brutal. And investing is essential to preserve your wealth. We hear a lot about risks of investing. We're afraid we may lose money by investing. Well, by not investing, you are guaranteed to be losing money. So it is very, very important. And that's a small assignment. Look at how much savings you have and calculate how much money are you actually losing right now. How much money have you lost in the first half of 2022 when you did not invest anything, when your money was not invested in any investment assets? So let's talk about the most important part. What is investment? By definition, investment is something which brings us regular income or will increase value in the future. And here there are images of three most popular investment assets we talk about a lot. It's the stock market, real estate, and gold. And all these assets we are going to discuss in this course. We will focus on the stock market, but we will talk about real estate and we will talk about alternative assets as well. But let's go a little bit back of investing, and let's actually think that investment is not something new. We might not be taught about it, and our parents might not have been doing it, but investment exists for a really long time. Here there is a very old image about one of the first investments, and this is financing merchant ships. So in the past, rich people, they gave their money to a merchant to go with a ship somewhere to the colonies to buy their goods which were needed, to bring them and to sell them. If they were successful, they would receive part of the profits. If they were unlucky, the ship would sink or it would be robbed. There are many things could have happened to it. But that's in a very remote past. Not so remote past. 19th century, many of us probably saw Westminster Abbey. Well, the cook there invests in a real estate property. Now she rents a property to have an income. The family, they invest and they make an unfortunate investment on the stock market. So it exists for more than 100 years. And real estate investment and the stock market is something which existed for pretty long time already. Principle behind investing. And that's, I want you to start thinking about why people invest. What is investment? Well, investors, they have too much money. They have excess of liquidity of money, and businesses need money to grow. So every time actually we invest in something, we give our money to a business which potentially can earn money and can grow. And our investments helps this business to grow. Bonds and shares are two key types of investment assets. And these are only two things you have to understand. And if you don't have business education, these are two things you have to learn about. The rest is really not so complicated. So if you never heard about bonds and shares, I will share more educational videos about it. But let me explain you the principles and the main things about bonds and shares which will make sense. Bonds and shares. And in a moment, you will understand why. Bonds. The principle behind any bond is that we lend the money and we will get our money back. So there is actually a contract which stipulates the period at when we receive our money back, after which period, and the interest rate which will be paid to us on a yearly basis. So a bond usually is structured this way. We know we will receive money, we know how long time it takes, and we know which interest rate this bond is paid on a yearly basis. It is a money lending instrument. So we lend money. It's also called fixed income. It's called fixed income because the interest rate is fixed in advance. It's the same every year. That's why it's called fixed income. So if we read financial news, we will see this phrase. And so we now understand that they refer to bonds. In Spanish, it would be renta fija. Bonds are considered more secure. Risk of any bond depends on the issuing party. So it depends to whom you lend your money. So if you lend to a company, there is a difference between a company as Apple, which actually also could issue loans, or a real estate agent which is building a new building. So there are lots of real estate bonds. When a company collects money, issues bonds, collects money to build a building, and then at the end of the period when the building is ready, when the apartments are sold, you are supposed to receive your money. So there is a big difference between a bond and the risk which is associated with it. Also, we see and we hear mainly about bonds issued by governments. And again, the risk will depend on the type of government we are dealing with. There will be difference between a German government or Argentinian government. So bonds are this kind of financial assets. Government bonds, they used to give attractive returns. They don't give attractive returns at this point of time, but they are considered rather safe. And everyone is advised to have this kind of financial asset in their portfolio. And if you have any pension plans, then for sure you have lots of bonds in your pension plans, because this is a safe way to have money there. Again, very low returns, but potentially also not so much decrease in value. Stocks. Well, with the stocks, the situation is different. We give money to a business in return for a share in a company. We become owners of that company. Even if we buy one stock, we are considered a shareholder or a small owner of the company, a small co-owner of the company. So nothing is guaranteed. We are not expected, nobody is expecting to pay us back our money. We became the owner. So we will have our share of the good and of the bad. So this is a big difference. Stocks are called equity. So when we read the news, when we hear the word equities and what is happening with equities, well, this is when they talk actually about stocks. In Spanish, it would be renta variable. Two investment assets, bonds and stocks, very different. According to official theory, according to what is written in books, everyone should have stocks and bonds in their portfolio. Depending on what is your risk profile, you should have more stocks or more bonds. There is a very popular ratio which is related with our age. The ratio usually is like this. If I have a portfolio of 100 and today I'm 45 years old, so then I should have 45% of my portfolio of my money in bonds and the rest should be in stocks. As I get older, I should get more bonds related to my age. So if I'm 60, then 60% of my money should be in bonds. If I'm 70, then 70% of my money should be in bonds. That way, I have a more secure portfolio which moves with my age. So if you're buying any investment products, if you're talking to financial advisors, when they start asking you for your risk profile, when they give you different questions, trying to understand how risk averse you are, what they are going to do, depending on how risk averse you are, they will give you more bonds in your portfolio. And that you have to understand. And today, bonds don't really give many returns. So what could have happened in the past? That you bought some mutual funds, that you made some investments through the bank, where you said that you are a conservative person and you don't want your money to fluctuate a lot. You are afraid to lose. So basically, you were given portfolio with lots of bonds, and these assets in the past 20 years were given very, very low returns. So you could have noticed that your invested money were not moving at all, were not growing, or actually decreased in value. Well, that is very much possible because since bonds are not really giving lots of returns, but financial institutions are still taking their cut of management fees, then it is possible that your portfolio actually performed very poorly, though being unofficially a very secure portfolio. Other investment assets which are considered alternative assets would be real estate and precious metals, art, or investing in startups. So when we talk about investing in real estate, We are not talking about the house you live in, because if you live in it, it's not giving you any income. Yeah, so this is owning a property, but which doesn't give you any income. So it's not really an investment asset per se. We will discuss more of it in the chapter about real estate. As a beginning investor, you shouldn't look at any alternative investments before you have your stable investment portfolio and before you purchase any assets as stocks and bonds. Yeah, so no crypto to start with. Actually, as you can see, crypto is still not even an official investment asset at all. So hold a little bit on buying crypto before you finish the course and understand the basics of investing and building your long-term portfolio. When we look at our investments, the most important part is understand the return on investment. And here we have this formula, how to calculate it. So for somebody who doesn't like math, it's quite maybe overwhelming, you don't like formulas, but basically you have to calculate a percentage of your income versus the amount of money you invested. So if you made $10, it makes a big difference whether you made $10 investing 100 or you made $10 investing 1,000. Yeah, in the first example, you made a very healthy 10%. You made $10 out of 100, so this is a healthy income. In the other case, when you invested 1,000 and you made $10, that's 1%, and that's not so much actually. It doesn't even cover inflation. So you always compare what you earn with how much is invested. And this is what we are going to do from now on. So we are not talking about I made $200, I made 1,000, I made 800. No, we're talking in percentages. Here we have one exercise. If you bought a stock for 100 and you sold it for 150, what is your return on investment? I give you some time. I suggest that you pause the video and calculate it for yourself. And when you finish, you can check the answer. And the answer is yes, the answer is 50%. I give you another example. I bought a stock for 500. I received $10 of dividend and I sold it for 500. If you don't yet know what is a dividend, well, dividends, some stocks pay dividends. So it's a part of the company profits which you actually receive, which you receive in your pocket. So in this case, you have a stock which is worth 500 and during the year you received $10. It's really went into your pocket. So what is return on investment? Well, return on investment is actually 2%. So the next question I will ask you, which one is better, the first one or the second one? Have a think about it. If necessary, pause the video, think about it, decide which one is better. The answer is you cannot answer this question actually because my question was incomplete. I did not specify the period. Now, we actually don't know if it took you 1 year, 1 month, or I don't know how much, and if the period was the same for the first investment and for the second investment. And so if we don't know the periods, we don't know for sure if the periods are the same, then maybe this is actually, these investments we actually cannot compare. So when we do trading, and let's say the idea of investments we hear about is exactly the first type. Now, when we bought a stock and we sold it and we made a profit. And there, getting a 50% return is possible. There are stocks which offer you 50% return, and it could be even in a short period of time. But the thing is that you might make this profit in a short period of time, but the question is, what will you do with your money afterwards? So if you make one trade, if you earn this money, but then afterwards you don't know what to do with this money and it just sits there, then well, then during this period you're doing nothing. Your money is not growing. And so then the initial profit you made, you have to calculate it for the period your money was idle afterwards. And actually, if you're doing the trading and if you're buying and selling stocks, the chance is very high, and statistically, very few retail investors are able to play this game for a really long time without making losses. So you might win on some trades and then you will lose on other trades. And then also you have to calculate your return on investment as an average over a long period of time. Well, so in this course, we are not going to talk about trading and we are not going to learn how to buy and sell single stocks. We are going to learn a method how you can invest your wealth long term in products which are diversified, which are growing long term, and which don't give you work and headache. Which return should you expect? How much do you expect to receive and when? Let's think about it. Imagine you invested 1,000 euro in January 2021. How much should this money be worth a year from that period? What should be an annual return? And this is one thing which is important. You have to set your expectations right. You cannot expect miracles. And when you expect miracles, it's very easy to get into very wrong types of investments. And there are many people out there which are very keen on getting you on their trading platform, promising you sky is the limit. Return on investment on various investment assets statistically is this. So stocks give us around 10% annual return long term. If invested long term, 20 years, above 10 years, we can expect 10% return on stocks. And it would be 10% every year. It will be compounding. Next course, we learn what is compounding and what does it mean for your wealth if you invested consistently at this kind of rate. Bonds offer less than 5%, so it's not so much, but again, it's better, much better than nothing. Real estate, with real estate where you rent properties, 5% is considered a good return after all the costs you have and after all the issues you could have with your real estate. And gold statistically long term until now have been given 3%, so it covers inflation. So you will not get rich investing in gold, but it's another way to preserve your wealth. I hope you enjoyed this course. I hope you enjoyed this lesson and I hope you found it useful. There is one more homework assignment for you if you continue with the course. If you continue with the course, you will receive a financial dashboard. That's an Excel file which will help you bring all your assets in one place and analyze them. In that case, your assignment is to fill in the financial dashboard, to reflect on your wealth allocation today, and if necessary, adjust your financial priorities, the ones which you already did in the financial health checklist. You make a list of your financial actions and you put your actions on your calendar. So that would be your assignment number 2 if you follow the course and you decided to join me for this learning adventure. If not, you can do it yourself. You have to put all your assets and everything you have in one Excel file or on one piece of paper and look at it today. How much money, which percentage of your wealth is invested in real estate, in stocks, in bonds, as cash, and whether you're satisfied with this situation at this moment. So you can join the course by paying. There are different ways to pay for the course. Is a one payment or is a monthly installment. I hope you learned something today, and if you want to join, you can join live classes and live Q&A sessions. Live classes will be going on the first Monday of June. Live Q&A sessions will be on the first Monday of every month, so first Monday of every month. And you can ask your questions also to me by email and in the Google Classroom. All the materials you will receive from me in the Google Classroom. You will receive the class recordings, additional learning materials, and the templates. Enjoy your learning, and I hope to see you soon. Bye-bye.